Hi folks, Scott here, and this is the wrap for Wednesday, November 13th. Very, very interesting day today. Before I get into that completely, let's talk about what tomorrow may bring us. Now, there's several, actually a lot of patterns that are going to be triggered for tomorrow. I'm not sure if this will be a widespread 7-day, a WS7. I think this is still the widest range day of the past 7, just eyeballing it. I'm guessing it is, but in the worksheet, that could be a pattern. This was a trend day. This won't show up in the worksheet, but it's certainly something I'll look at testing tomorrow. It's going to be the 14th. We do have a heat gap set up. A heat gap would be a gap down above these highs, high from 2 days ago. So let me get over to daily charts, a little bit easier to see. That tends to be a real bullish consideration. Bullish scenario most of the time. It's Thursday of options expiration week. That'll be in our daily worksheet. Put in a new 200-day high close. So lots of considerations. The one that was most interesting to me that I just ran in the trader room, and I'm still scratching my head, so I'm going to share it with some of you because we have quite a few people that do their own testing just to see if you can confirm. In fact, I'm pretty confident I got it right. I'm just scratching my head a little bit surprised, but I just ran a study in the trading room testing for scenarios similar to the past 3 days where we gap down below the low of the 2 prior days, day 2 and day 3 ago. In fact, let me zoom in a little bit. So we gap down and open below the low of day 1 and day 2, and we closed above those 2 prior days. So a 2-day engulfing pattern, anticipating it's maybe happened 20 times in the past 10 years. To my surprise, when above the 200-day moving average, it's happened 1 time is what I got. 1 time. Someone else ran, I think they said they had 4 or 5 times. So it appears to be, and everyone has the chart set differently. It's a very rare pattern. I still can't believe it. It seems like it's happened more than that, but nonetheless, it's a rare pattern. It tells us something is unusual in the marketplace. So that's no good to focus on for tomorrow. So instead, I ran something a little bit more, less specific, but also very interesting in my opinion. And that is, I wanted to look at what happens when fading gaps after closing at least 1% higher than the open and at least a 20-day high close. So you have a big green candlestick is what's going to normally be the case when you close 1% above the open and at a 20-day high. I'll go to Gap Trader, my back testing tool, and there you go. Several things stand out. Almost 2-to-1 odds, at least a 50% more than that, 65-70% chance greater of gapping up in the morning than gapping down. Gaps in either direction have above average probability of fulfilling, and did have one trend day loser. My guess is when I rerun these numbers with the MTG stop parameters, this number will improve quite a bit and be a very profitable and solid scenario for fading the gap. And I will tell you, I just ran this, and I remember it was better than this. I just don't remember the numbers. And when I ran this number here, these numbers fell apart. Now, I can't remember how bad it was, but it wasn't nearly this attractive, I'll tell you that, okay? So I'll share the exact numbers with our members in the morning. So be careful on the gap up. And what that tells you is that you could get some volatilities. Shorts that were stuck today will be forced to cover on a gap up tomorrow. That may falter around some potential confluence area or resistance area. So you may want to look for a delayed entry if you get a gap up or an opportunity to fade an extreme like the first hour high or key technical level. Okay, a little food for thought, but interesting patterns in play for sure going into tomorrow. Going into today, it was a little less interesting. I had a couple-day pullback, big gap down, and let me show you what the data showed. Most of the indices gap down below the prior day's lows, and you'll see this was about a 50-50 play here. Targeting gap fill, the average of all eight individual indices gap guides, 50% win rate, 1.0 profit factor. So no edge whatsoever there. Big positive was down gaps on Wednesday of options expiration week. This is a variation of what I showed in last night's video. Very positive number. However, after a false update, and that's where you have a green candlestick but you close lower, problematic for down gaps, 50-50 trade historically. After a doji during a bullish market, problematic, even though we've had quite a few of late. So as I summed it up, Oh, and a couple other research patterns. This is the one I showed last night, very positive. Another variation Wednesday of OPEX weak gaps. Large down gaps after closing above the 10 and 200-day moving average historically. 45% win rate, 0.9 profit factor. In November, 6 of 16. So I think the thought being November is such a typically seasonally bullish time of the year, a large gap down catches people off guard and they're forced to cover. So you probably have a lot of funds that are doing more intraday trading, protecting profits, trying to ride moves to the upside. I'm just speculating there. Sorry, my door's open. I can't reach it. My dog's downstairs barking. But bottom line is the gap guides are neutral to even weak. And unlike yesterday, the worksheet mostly showed risk factors for fading large down gaps. The key was large. I ran it on several patterns, even this one here, large patterns. Just pretty much any large gap scenario when you've been stretched to the upside is risky. And that was the key concern today. And I probably couldn't have said any better than this. As always, and this was posted at 9:20 sharp this morning, Eastern Time. As always, any given gap on any given day can and will fill. So I would love fading them, but today's setups clearly show too much historical risk for fading the open. I'll wait and take my cue from the range guides. And as luck would have it, this sucker took off to the upside right away. You can see the first bar, there was buying and volume, and you do want to pay attention to that. That can be a sign of a combination of short covering, or I should say buying, either due to covering or initiating new positions. And it took off. The 15-minute range is this purple line here. The high breakout was favored today, and quite a few folks took it. I did not, because I actually did. Oh, in spirit of disclosure, I went short at 58 or 58 and a quarter on discretionary trade. Discretionary only, because this is a blood gap below the low of an up day. And often these are rolled over, and there was a pretty good chance of testing the open. I thought I was wrong. I got stopped out and lost 3 points. And I said I would I would consider entering a pullback on the 15-minute high breakout, but I was really getting cross signals in the market. I had such bearish data on a lot of other studies I had. End of day data showed 2/3 probability of running down at least 5 points below the open today across 5 different systems, which I'll get back to that in a moment. My new closing guides. What was I going to show you? I'll check the 15-minute guide. So high breakout. I'm looking for 6 or 8 to meet my criteria normally to trade it. Check. Leans that way, half a check, check, and check. 3 out of 4 meet my criteria. Look in the ETFs. 1, 2, and 3. 6 out of 8 with a half a check. So it clearly met my criteria. The problem was it was against market internals, and more importantly against my broader pre-market research on the gap and end of day data. And I'm just not going to, 15-minute range trades, I use a lot of discretion. I'm not going to go against them. So I decided I was confused. I admitted it in the trading room, and I just left it alone. A lot of folks took it and made 40 cents on the Spider, 4 points in the ES, and even more in the Russell. So I waited for first hour guides. The market did rally, and those were all winners. Neutral in the ES, but YM favored, NASDAQ favored, and Russell favored the high side. Look at this 3 out of 4 in the ETFs. Neutral in the Spider again, but favored in the diamonds, right at it in the Qs, and favored in the Russell. Market internals were improving dramatically. They're really a secondary consideration, and I started believing, based upon where we open, I don't have, hold on, they go right above this moving average. So this was I started believing, since we were still in that range, I ran some data that showed that being in that range increased the chances of gap fill today, and we had that 20-day moving average acting as support, that as we got inside the prior day's range, and importantly, check out the Russell and NASDAQ were both poised to break these trend lines. So we had another catalyst. There were plenty of positives. I started believing it and recognizing that as this market climbed higher, it could be in a position to keep grinding and running stops and just trend all the way up. And literally, we talked about that today. That this could be, and several people echoed and agreed with that comment in the trading room, that we could end up with a big day breaking out to new highs. Did I believe it? I didn't know. I didn't put money on it directly, but I did indirectly, and here's what I did. So first hour guys were favored. I didn't want to go long right into this confluence here, but I thought if we go running straight up, likely to have a pullback. because I would consider fading the fill, but instead I felt like the odds were still stacked to the long side because the first hour guides were so solid. And I went long with a delayed entry at 62 and a quarter. Called it out, posted in their announcement tab, scaled out +4 and +6 going to the highs. And then I was out a good part of the afternoon. Obviously, hindsight's 2020, but nice to hold on more. But I got 5 points on this trade, which was bigger than my discretionary short down here to begin with, which was good. So I ended up with a nice positive day. Had another family commitment this afternoon, but I did come in the room around the 1773 or 4 level, telling people I thought would likely climb higher. People were stuck on the wrong side. And the reason I said that, and this is what's interesting, I had really strong data favoring a breakdown this morning, but whenever you see good data not following through, when the markets don't conform with strong, consistent data in one direction, it often turns into a rout in the other direction. Now, that's anecdotal, just observational. I've noticed this over the years, and many of our members have as well. And I believe it's because big money is seeing the exact same, the hedge funds, etc., seeing the exact same historical data and technical setups, and it gets lopsided. Folks are shorting, and it just feeds itself as they're forced to cover as the day goes on. The big money will wait to the very end of the day when it's clear that they're not going to get a reversal, and then they'll cover. And that's why you had this volume come in at new highs. There was no technical levels until you got up to the 79 or 80 level. And it was just a beautiful trade that unfortunately I missed due to a family commitment I couldn't get out of. But a lot of folks in the trading room took that, it sounded like. So happy to help in that regard. And interesting day. Tomorrow should be interesting as well. And that is the wrap for what is today? Wednesday, November 13th. Have a great one.